Ever felt a bit lost in the complex world of finance, wondering how anyone keeps the playing field level? Today, we're cutting through the jargon. We're diving deep into the foundational rules, the ones that govern securities trading. We'll explore some crucial FINRA regulations, prohibited activities, all designed to protect investors like you and maintain market integrity. We've got this fascinating stack of regulatory insights here, focusing on where things can and sometimes do go wrong, and importantly, how the rules try to prevent that.
Yeah, and our mission really is to unpack these rules for you, help you understand their purpose, the why behind them. You'll get a clear picture of what's prohibited, why it absolutely matters to you as an investor, and honestly, the surprising depth of protections already in place.
Okay, let's jump right in then. Let's explore some specific rules designed to keep things fair. Maybe start with how your individual trading orders get protected. Because when you place an order, right, to buy or sell something, there are strict rules safeguarding that order. Like a broker dealer can't just take your order, whether it's a market order or a limit order, and then go execute a trade for their own account at the same price. On the same side, buy or sell. It's about making sure your order isn't pushed aside.
That's exactly right. It's called trading ahead or front running in some contexts. So imagine you put in an order, say buy 1,000 shares of AME at $35. If the firm then buys AME at $35 for itself, well, the obligation is immediate. They must fill your order at $35, or maybe even better, within 60 seconds.
60 seconds.
Yes, it's quick. And this rule isn't just some, technical point. It's fundamental. Think about it. If you always suspected your broker would jump ahead of you, who would trust the market? So this regulation is crucial for that level playing field, preventing a kind of two-tiered system. It reinforces that your order gets fair consideration.
But you mentioned there's a nuance. What if different departments in the same big firm are involved? Is there an exception there?
Ah, yes, that's a key point. There is an exception, but it's conditional. If you have separate departments operating truly independently, and crucially, they have strong information barriers set up between them, and the department trading for the firm's account genuinely had no knowledge of your customer order, well, then the firm might not be in violation.
Information barriers, like
Yeah.
walls between departments?
Sort of, yeah. They used to be called Chinese walls, now information barriers. They can be physical separation, but more often they're procedural. Things like separate computer systems, rules about communication, compliance oversight. The firm has to prove these barriers are effective, that information didn't leak across.
Okay, that makes sense. So that covers protecting my order. What about how firms show prices? Like if they want to quote the same stock in different places?
Good question. If a broker-dealer displays a quote for the same security in more than one market, maybe on different exchanges or platforms, the rule allows it. But, and this is the important part, it requires the same price to be displayed across all those mediums.
Same price everywhere.
Exactly.
Yep.
If they offer to sell stock at $20 in one place, it has to be $20 in the others they're quoting simultaneously.
Right.
Why? Well, it ensures price consistency, right? It prevents confusion, or worse, manipulation, where maybe they try to offer different prices to different folks depending on where they look. It's all about transparency.
Right, keeping it consistent. Okay, let's shift gears a bit, maybe talk about mutual funds. Are there special rules when one fund trades with another, especially if they're like under the same corporate umbrella?
Yes, there are exemptions for that, designed for operational efficiency, but with, specific guardrails. Under the Investment Company Act of 1940, specifically Rules 17A6 and 17A7, there are conditions where mutual funds can buy from or sell securities to other funds. This often happens when they're portfolio affiliates, basically, funds managed or controlled by the same investment company.
Ah, okay. So they can trade between themselves without all the usual restrictions.
Under certain conditions, yes. They're usually considered minor transactions in the grand scheme of things.
Yeah.
The key is that the transaction has to be fair, typically based on independent market prices, and it can't disadvantage either fund. It allows for efficiency, like rebalancing portfolios within the family, but still aims to prevent self-dealing or favoring one fund over another.
Got it. Efficiency with guardrails. Okay,
Pardon.
let's tackle the big one, the one that makes headlines. Insider trading.
Yes. Probably the most famous type of market misconduct. So insider trading fundamentally involves buying or selling securities based on material, non-public information and doing it in a fraudulent way.
Material, non-public. Break that down a bit.
Sure. Material means the information is significant enough that if the public knew about it, it would likely affect the stock or bond price. Think, a surprise merger announcement, unexpectedly great or terrible earnings, a major regulatory decision.
Something big that moves the needle.
Exactly. And non-public means just that it hasn't been disseminated broadly to the investing public yet. The fraudulent manner part usually involves someone misusing confidential information they have because of their position, like a director, officer, even an employee breaching a duty of trust. Or it could be someone misappropriating information, maybe stealing it from their employer.
Okay, and this is important, right? Trading because you know a big client is about to buy or sell a ton of stock. That's not this, right? That's different.
Correct. That's front running, like we discussed earlier with protecting customer orders. That's about misusing knowledge of market activity. Insider trading is specifically about misusing corporate information internal to the company itself.
Gotcha. So if a company has this big news,
They must release it to the public before anyone privy to it can legally trade on it. And they can't just tell a select group, like just analysts or favored broker-dealers. That's prohibited selective disclosure. Giving it to the financial news media, like a major wire service or filing it with the SEC, that's generally considered making it public.
but it gets complicated, right? Like, what if someone tells someone else? The information spreads.
That's where tipples and tippies come in.
Huh.
This is really interesting. If someone with the inside information, the tipper, passes it along to someone else, the tippy, and that ticky trades on it, well, both of them can be liable.
Both. Even the person who just received the tip.
Yes, if the tippy knew, or frankly should have known, that the information was confidential and improperly disclosed. Think of a CEO, tipper, telling a friend, tippy, about an upcoming merger before it's announced. If the friend buys stock, they're both potentially in trouble. And the brokerage firm where the trader works can also be held responsible for its employees' actions, even if the firm itself didn't trade or benefit.
Wow. Okay, so the responsibility goes pretty wide. And you mentioned this isn't just theory laws have changed because of actual cases.
Absolutely. High-profile scandals in the 80s led directly to new legislation. There was the Insider Trading Sanctions Act of 1984, ITSA, and then significantly the Insider Trading and Securities Fraud Enforcement Act of 1988, usually called ITAA.
IDSAA, what did that do specifically?
ITSAA was a big step up. It really put the onus on broker-dealers, on the firms themselves. It required them to establish, maintain, and enforce written policies and procedures reasonably designed to prevent the misuse of material, non-public information by the firm and its employees.
Written policies. Okay,
Okay.
so what kind of procedures are we talking about? What do firms actually have to do?
It's pretty comprehensive. They need systems for monitoring trading by their employees and any trading the firm does for its own account, proprietary trading. They need to restrict or closely monitor trading in securities where the firm might possess insider information. This is often done using watch lists and restricted lists. And they need procedures to limit access to confidential files and information, going back to those information barriers between departments like research, investment banking, and trading.
Okay, watch lists and restricted lists. What's the difference there? That sounds interesting.
Yeah, there's a key difference. A restricted list contains securities. The firm and its employees are generally prohibited from trading, or where trading is heavily restricted. This list must be disseminated to employees so they know what they can't trade. A watch list, however, is different. It includes securities that might be sensitive, maybe because the firm's investment banking side is working on a deal involving that company. Trading in watch list securities isn't usually prohibited outright, but it's subject to much closer scrutiny, typically by the legal or compliance department. And here's the interesting part. Watch lists are usually kept confidential, known only within legal and compliance.
Confidential. Why keep that secret from employees?
Well, think about it. If employees knew a stock was suddenly put on the watch list, it could inadvertently signal that something big is happening with that company, right? It could lead to speculation or even front-running based on the existence of the watch list itself. So the secrecy helps prevent that unintended information leakage.
Ah, okay, that makes sense. So if, say, an investment banker comes across some major non-public info.
The absolute best practice, the required practice really, is for that person to immediately notify their compliance or legal department. They don't trade, they don't tell their buddies, they go straight to compliance. Compliance can then assess the situation and, if necessary, place that security on the firm's watch list or restricted list, triggering the appropriate controls.
Okay, so the systems are there. But what happens if someone does break the rules? What are the consequences? You said they're severe.
Oh, they are definitely severe. We're talking both civil and criminal penalties. On the civil side, the SEC can seek penalties of up to 3 times the profit gained or loss avoided. That's known as treble damages.
3 times. Wow.
Yep. Plus, they can demand disgorgement, basically, giving back all the illegal profits. And it's not just the trader. Managers or supervisors who fail to take appropriate steps to prevent the violation can also face hefty civil penalties, potentially up to $1 million, or 3 times the profit loss avoided by the person they supervised.
Okay, that's civil. What about criminal?
Its facia significantly upped the criminal penalties, too. We're talking serious jail time and fines. For individuals, it can be up to $5 million in fines and up to 20 years in prison per violation.
Per violation. So multiple trades could mean multiple sentences.
Potentially, yes.
Yeah.
And for corporations, the fines can go up to $25 million per violation. Criminal actions are typically brought by the Department of Justice. So you could face parallel actions from both the SEC, civil, and the DOJ, criminal.
That's incredibly serious. And you mentioned something surprising earlier, bounties.
Yes. Another interesting feature of AdSafe. The Act allows the SEC to pay bounties to informants. People who provide information that leads to the imposition of penalties can receive anywhere from 10% to 30% of the money collected by the government.
So like a whistleblower reward.
Exactly. It's a pretty powerful incentive for people with knowledge of insider trading to come forward.
Okay, wow. That's a lot on insider trading. Let's maybe pivot now to another really key area of fairness. Initial public offerings, IPOs, those hot new stock offerings.
Right, IPOs. Another area where there's huge potential for things to be unfair if not regulated properly. Because, IPOs often see that big price jump right after they start trading the IPO pop. Creates massive demand. So FINRA has what's called the new issue rule. Its main purpose is to ensure that brokerage firms make a genuine, bona fide public offering of these new issues.
Bona fide public offering.
Meaning they can't hold back shares for their own firm accounts or for their employees' accounts or for other industry insiders. It's all about ensuring the public gets fair access to these potentially lucrative offerings, not just the connected few. The rule basically says a firm cannot sell a new issue to any account where a restricted person holds a beneficial interest.
Okay, restricted person. We'll get to who that is. But first, what exactly counts as a new issue here? Is it every single new stock?
Good clarification. No, not everything. A new issue under this rule specifically refers to an initial public offering of an equity security, sold under a registration statement or offering circular.
Equity security IPOs. Got it. So what's not covered? What can be sold to these restricted persons?
Quite a lot, actually. The rule does not generally apply to secondary offerings, meaning stock that's already trading, private offerings like Reg D or Rule 144A deals, pretty much all debt offerings, including convertible bonds and high-yield debt. Preferred stock isn't usually covered either. Also exempt investment company offerings like mutual funds, exempt securities like municipals, direct participation programs, DPPs, REITs, rights offerings, exchange offers, shares issued in M&A deals, and certain ADRs. So the focus is really narrow, that initial sale of common stock to the public for the very first time.
Okay, that's much clearer. So equity IPOs. Before a firm sells shares in one of these, what do they have to check?
Due diligence is key. Before selling a new issue to any account, the firm must get a written statement, a representation from the account holder. This statement basically confirms that the account is eligible to purchase new issues according to the rule, meaning no restricted persons have a prohibited interest. And they can't just get it once. This eligibility needs to be re-verified at least every 12 months.
Okay, makes sense. So now, the big question. Who are these restricted persons who generally can't buy these equity IPOs?
All right, this is the core list. Restricted persons include, first, FINRA member firms themselves and their employees, what FINRA calls associated persons. So, brokers, traders, investment bankers working at FINRA firms.
Okay, the firms and their people.
Second, the immediate family members of those employees. This includes spouses, children, parents, siblings, parents-in-law, sons, daughters-in-law. However, there are conditions for family members to be restricted. It's not automatic for everyone.
Conditions like what?
Well, generally, an immediate family member is restricted if 1. The employee provides material support to them or receives it from them. Material support is usually defined as providing or receiving more than 25% of the person's income or are living in the same household. 2. The restriction might apply if the employee works at the specific firm that is selling the new issue, part of the underwriting syndicate. And 3, if the employee is in a position to control the allocation of the new issue.
Okay. So if my brother works at a brokerage firm, but I don't live with him and we don't support each other financially, I might not be restricted from buying an IPO his firm isn't even selling?
That's often the case, yes. But if, say, you do live with your sister who works at the firm underwriting the IPO, you'd likely be restricted. It depends on those specific conditions.
Got it. Who else is on the restricted list?
Okay, also restricted are finders and fiduciaries involved in the offering, think attorneys, accountants working on the IPO deal, and anyone they materially support. Also, portfolio managers, but only when purchasing for their own personal accounts. They can still buy the IPO for the fund they manage, of course, but not for themselves personally,
Why restrict portfolio managers personally?
because they direct huge amounts of commission business. The idea is to prevent a situation where they might get preferential IPO allocations personally as a sort of thank you for sending trading business to the underwriting firm. It removes that potential conflict of interest. And finally, anyone who owns 10% or more of a registered broker-dealer is also restricted.
Right, that covers a lot of ground. But like with insider trading, are there exemptions here too? Situations where people or accounts can buy IPOs even if they seem connected?
Yes, definitely. There are some important general exemptions. Certain types of accounts are not restricted even if they have some connection. These include registered investment companies, like most mutual funds, the general or separate accounts of insurance companies, common trust funds, state and local government benefit plans, the ISA-governed plans, like many 401ks and pensions, and certain tax-exempt entities under IRA's Code 501c3.
So big institutional pools of money are generally okay.
Generally, yes. There's also a key de minimis exemption. An account can buy a new issue even if it contains some restricted persons, as long as the total beneficial interest of all restricted persons in that account doesn't exceed 10%.
Ah, the 10% rule. Okay.
And another one, what if the IPO isn't selling well? It's undersubscribed. In that situation, if the public doesn't buy up all the shares, the underwriter is allowed to place the leftover shares into its own investment account. But, and this is important, they cannot turn around and sell those undersubscribed shares to other restricted persons. They can keep them, but not distribute them within the restricted group.
Okay. And you mentioned one more really specific one, issuer-directed securities.
Right, this is a very specific carve-out. The rule allows people associated with the issuer, the company actually going public, not the brokerage firm handling the deal, to buy shares if the issuer specifically directs shares to them.
So employees of the company doing the IPO?
Exactly. Employees and directors of the issuer can buy shares of their own company's IPO if the company allocates shares to them. This is also the exemption that allows, say, a registered rep working at Goldman Sachs to buy shares if Goldman Sachs itself goes public, because they are an employee of the issuer in that case. It can also apply to other restricted persons if they happen to be an employee or director of the issuer company, not the brokerage firm.
Wow, okay. That makes sense. It allows employees to participate in their own company's offering. We've really peeled back a lot of layers today, covered a lot of ground on how these markets are designed to operate fairly, from order protection to insider trading, and now IPO access.
Indeed. And if you sort of connect the dots, you see the bigger picture, right? All these rules protecting your order, preventing trading on secret information, ensuring fair access to IPOs, they're all aimed at the same fundamental goal: maintaining investor confidence, keeping the integrity of the financial system intact. It shows this, well, meticulous effort to balance market efficiency with really strong protective measures.
So what does this all mean for you, the listener? Hopefully you're coming away with a deeper understanding of these vital safeguards, maybe feeling a bit more confident in the robustness of the markets because these protections are in place.
Yeah, exactly. And maybe it leaves you with a question to think about. We live in this world of incredibly fast information, new technologies all the time. How do these fundamental rules, some of which have been around for a while, continue to adapt? How do they meet new challenges to keep ensuring fairness for everyone involved going forward?
That's definitely something to mull over as you continue your own deep dives. Thanks so much for joining us today for this deep dive.